guys. I'm going to just go past apportionment with you because I've just been discussing what happens when we sell goods, and I just want to do it with you. So I've got here section 2, guys. It's on page 8. Disposing of assets when not all of the input VAT was claimed on acquisition. Is that all right? And guys, I want you to just look at the bottom of the page because there's a summary there. And I've got 2 blocks. Do you guys see that? And I've got here, when the disposal is as a result of an insurance payment or the giving of a fringe benefit. Does everybody see that? And I've just done fringe benefits with you. And what does it say? It says, output VAT is levied at the reduced input VAT percentage claimed on acquisition of goods. There is no VAT input claim on disposal. So guys, for fringe benefits and insurance payments, you can use something other than 100% for VAT output. So if you see an insurance claim or a fringe benefit, you can go times 30% or times 50%. Are you guys comfortable with that? And then it says where the disposal is not as a result of an insurance payment or the giving of a fringe benefit. I'm going to do some examples now. Okay? So it says where it's not an insurance payment and it's not a fringe benefit. Guys, it says output VAT is levied at 100%. Input VAT can be claimed on the percentage not yet claimed on the lower of original cost or open market value on the date that the asset is sold. And I know that sounds like Greek at the moment. Okay? And even for the Greek guys, it doesn't sound like Greek. Not right. I'm going to show you examples on how this works. Okay? So let's just go on to the next page. Guys, look at the illustration. It says a computer was bought for 345,000 Rand. 80% of the VAT amount of 45 was claimed as VAT input on acquisition. Okay. The computer was destroyed in a lightning strike and the insurance company paid out 115,000 Rand in compensation. Okay, now I need you to understand something. The reason insurance is in here is they try not to be punitive. Generally, an insurance claim is outside of your control. Does everybody understand? So they say only claimed 80% of input, therefore only need to charge 80% of output because it's an insurance claim. So do you guys see it's 115,000 times 15 over 115 times 80%. And then I've got there the mainframe shell was worth 34,200 and was given to the employee as a fringe benefit. Okay? Now guys, because it's a fringe benefit, what are you allowed to do? Times 80% as well. Are you guys comfortable with that? Does this make sense, guys? You happy? Okay. Now, guys, let's imagine we have the same example, but it's not an insurance claim. So the rule is fringe benefit or insurance claim. If it's 80% input, it's 80% output. So the next example says output, VAT, sorry, computer was bought for 345, 80% of the VAT amount of 45 equals 36 was claimed as a VAT input on acquisition. The computer was sold for 115. What are the VAT amounts on the disposal of the asset? Now, guys, I told you for everything else, what is output VAT going to be levied at? 100%. So what we're going to do is we're going to say it's 115,000 times by 15 over 115 times 100%. So that's going to equal 15,000 output. Happy. And what they say is because I've got the 15,000 Rand as 100% output, I can claim the remaining 20% of the input when I sell it because I've charged 100% output. And what can I do? I can claim whatever input I didn't claim on lower of cost or market value. So we say cost was 345, market value 115 when I sold it. So what am I able to claim? There's your output. And what's my input? Lower of 345 or 115 times by 15 over 115. And what did I claim originally? 80%. So how much am I allowed to claim now? 20%. Are you guys comfortable? That would be your input. Now let me just explain to you why the section is here. Okay. So let's imagine you buy a house and you decide that you're going to run your practice from 20% of your house. Are you guys comfortable with it? And you bought your house for 3 million rand. So when you buy the house, it's 3 million rand times 20%, because I'm using 20% of my spaces now to run my business, times 15 over 115. And that's going to be my input up front. Happy? Now, property prices go up. So let's imagine I sell the house 10 years later for 8 million. So I've got outputs on 8 million, and what is my input based on? Lower of cost or selling price. So I sold it for 8, what was my cost? Do you understand? Do you get screwed? Big time. So they're not being nice here. So what they do is they say, listen, when it's insurance and a fringe benefit, not necessarily under company's control, employees need it, we'll allow you to use the lower percentage. Every other time, screw you, because we're going to collect more money by doing this. Are you guys comfortable with this? Does this make sense? So this is something that gets asked in exams all the time. They give you apportionment, and there's an asset that gets sold, and you're going to have to say, is it insurance or is it a fringe benefit? No. I've got to do this calc. If it is insurance or a fringe benefit, I just times by 80%, and it takes care of it. Are you guys comfortable with that? Does this make sense, guys? So disposal of an apportioned asset, are you guys comfortable with? Is that cool, guys? Happy? Okay. Now, apportionment. Do I need to go through apportionment? I've been discussing it for the last 2 lectures, and I've done lots of examples with apportionment. Do I need to do it? Do you guys understand? I'm just going to go through and do an example. If you don't understand the example, then... Yeah. Sorry. Here we go. It says, A Limited purchased a property 3 years ago that had a petrol station with a retail complex. So this is on page 4. Sorry. I'm trying to actually just go through stuff. Do you understand that apportionment in postgrad is probably stock standard for an exam question? In undergrad, they could be nice with you. Because within undergrad, it was quite easy. It's like I call VAT a pregnancy section. Either you're pregnant or not. With VAT, either there's VAT or there's no VAT. Therefore, you've got a 50-50 chance of guessing right anyway. So it's nice in undergrad. Do you understand that? When you throw apportionment into the mix, it becomes a bit more difficult. So it can't be a pregnancy section in postgrad. Because it can't be, well, let's toss a coin and I've got a 50% chance of guessing right. Are you guys comfortable? So apportionment is very, very prevalent in postgrad. So it says, A Limited purchased a property 3 years ago that had a petrol station with a retail complex that includes a quick shop and various retail shops. Above the retail complex are 12 furnished flats that are rented out for residential purposes. A Limited had the following exit from their trial balance last year. Now, guys, I need you to understand why we're using last year's numbers. Because at the end of each year, what do? We look at our turnover at the end of last year, and then what do? Work out what our percentage apportionment is going to be for the year that's coming up. If you're buying it for the first time, they'll tell you what your budget is, and you'll take it off your budget. So, guys, rentals for renting out shops, is that vatable? Yes. Sale of fuel, it's 0 rated. So is it vatable? Yes. V. I don't care that it's at 0%, there's VAT on it. Quick shop sales, vatable. Residential rentals, exempt. So guys, in a question, you're not going to be given the percentage here. They'll sit there and they'll say 6.4 is VAT. 1.6 is non-VAT, gives you 8 million, and you're going to work out an 80% VAT input ratio. Are you guys comfortable? They don't have to give you the 80%. You're going to work it out on turnover. And the way in practice it works is that you do it on turnover unless otherwise stipulated. Okay. There's the following transactions occurred in the current year. Beds were bought for residential flats for 16. Is there VAT? Can we claim VAT input on that? That is 100% exempt. Therefore, we can't claim any VAT. Quick Shop chocolates bought from VAT vendors for 51.60. It's 100% VATable. Therefore, 100% VAT can be claimed. Electricity of 18 for the whole complex. Times the 80% times by, because that's for both of them, both places. And fuel of 124 purchased at a garage. Fuel zero rated, so you just put it in at zero. Are you guys comfortable? So that's kind of like a dynamic that you need to do. And you'll see one of the first touch examples I do, the teaching example that they've got inside your assignment has got an example similar to this. So this is quite a common way of actually asking something in an exam. Are you guys comfortable with this? So apportionment, you guys comfortable with? You know what to do. There's a lovely, much more detailed example just behind here, if you want to go through and have a look at it. Okay. Yeah, I've modeled that on one of the class tests from about 10 years ago. It was very badly answered, but it's not difficult if you do it. So what I'm interested now is going on to change in use now. Okay. And with change in use, guys, I'm going to go all the way to the end of change in use because there's a diagram there. And guys, that page is open for you to write on. Yeah. You can, yeah. No, I've never seen that being done. Normally they don't get so nasty. That if it's an apportionment question, it's an apportionment question. Okay. But the one thing that they do integrate with apportionment though is change in use. So I just want to actually just discuss this with you. Okay. Okay. So here's how it's going to work. You've got two changes in use, partial and total. Everybody remember that vaguely from undergrad? Okay. So I need you to understand the difference between these two in an exam. Because often the biggest mistake that people make is that they can't distinguish whether it's a total change or a partial change. And let me just explain. The most important thing here, and I've got it there, but I'm going to write it down here. This is no VAT to VAT. And that one is VAT to VAT. Or this one could be VAT to no VAT. Is that all right? So one of them, you're going from something that's non-VATable to something that's VATable. That's what we call a total change in use. And partial change, guys, is where you go from VAT and the percentage just changes each year. So guys, I can't rent out any of my shops, and I can only rent out the residential accommodation. So it goes from 80-20 and it now becomes 50-50. That's a partial change because I've gone from 80% VAT to 50% VAT. Are you guys comfortable? Is that cool? So guys, what happens if you go from 0% VAT to 40% VAT? So all of it is residential, but now I'm using floors 2 and 3 as a hotel, which is VATable, and I'm using the other floors as residential. 0 to 40 is what? It's total change. Because I'm going from no VAT to VAT. And I don't know what it is. That's the one that in exams causes trouble because people seem to think it's a partial change, and it's not. The rule for total change is it's not VAT, and now it is VAT, or it was VAT, even if it's 20% VAT, and now it's not VAT anymore. So did you guys see here on the thing, 100% to 0 or 0 to 100? I know that you won't make a mistake with that. But 0 to 40 and 40 to 0 is also total change. Now, I'm just going to use something from a practical point of view just to actually explain this. So guys, you own a pharmacy and you decide that there's a woman that comes in just before closing and she gives you a telephone number and you know you're going to get lucky tonight. So you walk, you take the condoms off the shelf and you put it into your pockets and you walk out the shop. From a VAT perspective, is that a total change in use or a partial change in use? total. It was 100% vatable, and now it is 0. Guys, comfortable? So what's going to happen, guys? When do you think you need to account for that? When? Just logically. That's why I'm trying to get you to understand it logically. Is that box of condoms ever going to be put back on the shelf? No. Therefore, what is going to happen? You're going to adjust now, because it ain't never changing. Are you guys comfortable with that? Okay. Let's just imagine there's exempt here for UNISA, and let's imagine that we also do professional stuff, which is vatable here. So in January and February, there's lots of UNISA registration, so we pretty high on an exempt side, imagine. Okay? But in March and April, there's almost no UNISA registration, so there's almost 100% professional, which is vatable. Does everybody understand? So do you understand that for a partial change, so at the end of the day, we don't know how much is exempt education and how much is vatable professional services? We don't. But do we change it each and every single month for a partial change? So do we sit there and say, oh, it's 100% exempt in Jan and it's 100% professional in March? Do we change it? Do you understand that it's impractical to change things every single month? You wait for year end, and then what do? You look at the sales. Are you guys comfortable with that? So, guys, what basically happens here is the time of supply is immediate for a total change. Do you guys see that in the block? Whereas for a partial change, what do? It says the time of supply is in the year-end VAT return. Does everybody see that? So once a year, we take out the income statement, and what do? We have a look to see what's in our sales column. Just like in that example I just did with apportionment of VAT, we added up all of the vatable items, we added up all of the exempt items, worked out a percentage, and that's what we've got. Are you guys comfortable? So time of supply for total change, immediate. Time of supply, year-end VAT return. So I've got here changes. Examples include 40 to 70, or 100 to 20, or 35 to 60, VAT to VAT. Correct? And it says the cost of the asset must be greater than or equal to 40,000, including VAT, by the way. And the change in use must be greater than or equal to 10%. We are not going to go and look for every single asset in our books, because my financial calculator, can you imagine if we had to actually do a VAT adjustment on my financial calculator every year? Cost $400. It's impractical to go and take low value assets and actually do partial changes in use in them. And my financial calculator would actually be a partial thing. If I buy a copy of silk would be below 40,000, and I'd have to adjust it. You understand it's not practical to do it for all assets. So for a partial change, it's only assets that are greater than or equal to 40,000, and we only adjust if it's greater than or equal to 10%. Are you guys comfortable with that? And again, I'm going to get you to tag your books, and you'll have all of that tagged, so it's not going to be a problem. Now, I need you to understand something. If it's output VAT, I don't know whether you want to write this down. It works on screw the taxpayer, output VAT. Is that all right? Let me explain. SARS wants to collect as much money as possible. So, screw the taxpayer. Scan on market value. They want it as big as possible. If it's an input VAT claim on a total change, what do? Lower of cost or market value. Screw the taxpayer. So total changes always work on screw the taxpayer. If it's an output, it's on market value. If it's on an input, it's on lower of cost or market value. Are you guys comfortable with that? If it's a partial change, it's always on lower of cost or market value. If it's a partial change. Are you guys comfortable with this? Okay, so I'm going to do a couple of examples with you now. And these are the ones that cause trouble in an exam. Okay, so please be careful. So let's go back up. Okay. So guys, bottom of page 11, using an example to explain the SARS partial change in use rules. It says SARS allows an adjustment to be made in certain circumstances for a partial change in use. Company A has a factory, vatable supplies, and also provides residential accommodation to employees and their families and exempt supply. In year one, factory sales are 4 million and rentals are 1 million, which is 20%. In year two, factory sales are 9 million and rentals are 1 million. Okay. Year one had 80% vatable supplies. Year two is 90% vatable supplies. There's a change in use of 10% over the year. Are you guys comfortable with that? Conceptually, you're happy. When is the SARS adjustment to VAT made? Year-end VAT return. Can't do it monthly. You've got to do it once you do your financials for the year. Guys, comfortable. By the way, if they put dividends into your income statement, what do you treat dividends as? So it's not only residential accommodation. Residential accommodation is very common. If they put dividends received, what is a dividend received? It's a financial service that's exempt, by the way. So you'll add the dividend and the rentals together, that will be exempt, and everything else will be vatable. So remember, dividends can actually go in there as well. And there's the formula. So let's just have a look. Illustration. The company bought a second-hand machine for 570. 342 is payable on delivery in March, and the remaining 228 and 31 May. The company year-end is April. The machine had a market value of 560 at year end. There's a change in use from 40% last year to 70% vatable this year. The company submits VAT returns monthly. Are you guys comfortable? So guys, before we do a partial change, we're going from 70 to 40, which is a partial, yes? Is that okay? So what do? We say it's 15 over 115 times. Because it's a partial change, do we use lower of cost or market value? So cost was 570, market value is now 560. So you're going to use the 560 times by, what's going to happen, guys? We're only going to make an adjustment if it moves by more than 10%. Has it moved by more than 10%? Yes. And it costs greater than or equal to 40. Is this cost more than or equal to 40? And what do we put in the year-end VAT return? 13,147. 15 over 115 times 560 times 30%. Okay. Are you guys comfortable? Times 60% here, because it's fixed you can only claim based on what you've already claimed yet. To second-hand goods from a non-vendor. Second-hand machine from a non-vendor, I can only claim limited to payment. So I've only paid 342 so far, therefore I can. I've paid 60%, therefore I can only adjust 60%. What happens when I get the payment after year end? I'm now going to base it on the new percentage, because I've now got a new percentage in my business. Because the percentage has changed from one year to the other. Are you guys comfortable with this? And that's probably one of the hardest ways that they can actually ask it to you. That's cool, guys? Okay, let's carry on. Next one. A mainframe computer was bought by a property rental company and cost 115, including VAT in the current year. The computer was used to record all the accounting transactions of the company. The company rented out residential and commercial property. So residential is exempt, commercial is vatable. Does this make sense? Okay. Says in the prior year, commercial rentals totaled 70% of rentals and residential rentals totaled 30%. When the computer was purchased, the 70% input VAT was claimed. The company's year end is October. The company is a category A VAT vendor, submitting VAT returns monthly in September and November. In February of this year, the company decided to sell all residential properties, and all these residential properties were sold in March. So we've gone from 70% to what? 100. Do you guys understand? Partial or total? Now, some people have said total. It's not total. We've gone from 70 to 100. What do you need to have a total? You need a 0% for a total. Is that all right? So even though we know it's changed, when do we have to wait for? Now, the year end of the company is October, yes? And We're in A category, so it's September or November. So we don't have an October VAT return. So which VAT return are we going to use? The one after year end. Because September, we don't know what our final total is yet. We've got to wait to work out what our final total is for the year. So we've got to need our financial statements to work out what our total is. Okay? And then what's going to happen? We've gone to 100%. So what are you going to do? Now, if you're going to discuss it, guys, it needs to be a partial change in use. 70 to 100 is a partial change in use. We've gone from VAT to VAT. Next requirement, guys, must cost more than 40 or more, including VAT. Cost was 115. And then the change in use needs to be 10% or more. It's 30, so it's there. So what are we going to do in the November VAT return? It's lower of cost, 115, or market value, 79.2. So which one are we going to use? 79.2 times 30% times by 15 over 115. And guys, is this an input or an output? I claimed too little in the past. I only claimed 70. Now I can claim 100. So it's an input. Guys, comfortable? Does this make sense? Do you understand why you've got to wait for year end? Okay. So that's there. Guys, this illustration I'm not doing. The reason I've got this illustration is if you've got a company that's starting up. So the reason I've got this is, how do you get your initial percentage if you're a company that's starting up? So whatever you submit to SARS is your budget, and SARS has got to accept that budget. So the first year will be based on your budget, and then you'll adjust each year. Now, guys, if it's 55, and then it's only 59, and it hasn't moved by 10%, you keep it at 55. The next year, you'll see whether it's moved more than 10 away from your number. So if it doesn't move by more than 10, you keep it at that percentage. Are you guys comfortable with that? So that's there. Let's go into total change now. Total change in use. So guys, I've got the SARS rules. Total change in use, non-VAT to VATable. When is the adjustment to VAT made? Immediately. Now guys, if we're going non-VAT to VAT, what's going to happen with non-VAT to VAT? Input or output? It's input. And what do you do if it's an input? Remember, total changes are based on screwing the taxpayer. So if you want to make it as small as possible, what do? Lower of cost or market value. Are you guys comfortable with that? Okay. So, illustration. A company with a December year-end only has one asset, a block of flats with 50 units that let out for a minimum 12-month periods to tenants. All these rentals are exempt supplies for residential accommodation. The company has an August year-end. Okay, guys. On 1 March, a decision was made to use 40% of the flats as holiday flats, renting out flats for short periods to holiday makers. These rentals are VATable as the provision of commercial accommodation. You guys comfortable? It's like a hotel. Guys happy with this? Now guys, it was 0%. What is it now? 40%. 40% VATable. So 0 to 40 is what? Total change in use. It says the flat cost 2280 when originally acquired by the company at a market value of 5.7 on the date that the change in intention took place. So, suggested solution, total change 0 to 40. Input VAT, it's lower of cost or market value, so the lower of the two, which is 2280, times 15 over 115, times by 40%. Now guys, even if you bought that asset under a 14% VAT regime, you still do it at times 15 over 115. Doesn't matter what the original VAT rate was. Is that okay? Yep. It has to be done immediately. So often what they do in a question is they ask you to do a journal entry, and there's a trick with a partial. You're going to say, there's no VAT entry at the moment because we've got to wait till year end. And then certain people do 12 million times worth of calculations, and it's only out of 1 mark because you're supposed to say it's a partial change. There's nothing that happens in March. Okay, and it's only out of 1 in the exam. Whereas guys actually all of a sudden spend 15 minutes wasting their time. But if it's a total change, immediately. Does that make sense? Immediate. The moment they change intention, you do the adjustment. So it goes immediately into your VAT return. Okay? Guys, VATable use to non-VATable use is slightly different. I just want to show you an example because there's something that is going to be there that you're not going to expect. So it says, Mr. A owns a pharmacy and is registered as a monthly VAT vendor. The pharmacy trades as a sole proprietor. Mr. A has a date with his girlfriend, and upon closing the store, bought condoms off the shelf. The condoms originally cost $22.80. Okay. The pharmacy condoms normally sold for $45.60. Pharmacy submits returns monthly and has a February year end. So guys, that's a total change in uses. Now guys, is it an input or an output if you go from VAT to non-VAT? Guys? It's an output. So what do? SARS wants to maximize the amount of output. So what do you do it based on? Market values. Can you see in the solution it's based on the higher number, $45.60. Times 15 over 115, $5.94. Guys, comfortable? Then, guys, I need you to understand something. There's an illustration there, 40% to 0%. Does everybody see that? Before you look at the example, tell me why this one's going to be different from the one that I've just done with you. What did I do directly at the beginning of this set of notes? I said disposal of assets where you didn't claim more than 100% worth of input. So with the condoms, it's simple. It's 100% change. So I just do output on 100%. Do you understand that where it says 40% to 0, I've got to charge output VAT at 100 and claim 60% input VAT? Because that's how we do disposals of those items, unless it's a fringe benefit or an insurance payment. So it says company bought an asset was used 40% for VATable supplies. The cost was $39.9, and $39.9 times 15 over 115 times 40%, 2081. Company has a junior end. In February, the asset was used only for exempt supplies when the market value was 45.6. At year end, the market value was 39. Now, guys, I just need you to understand, in a partial question, you base it on market value at year end. Is that all right? Because when do you do the VAT adjustment for a partial? Year end. If this is a total change, you're going to base it on the date when the asset change in use. So it says there's a total change in use from 40% to 0%. A VAT adjustment will be processed in the February VAT return when the total change in use took place. Output VAT of 100%. Because remember what I said to you. I said if you didn't claim all the input, if it's insurance or fringe benefit, you can use the low percentage. But is this insurance or fringe benefit? So what have I got to do? Output VAT on everything. And then input, lower of cost or market value. So I'm going to use the 39.9 times 15 over 115 times 60% gives you 3052. Are you guys comfortable? So not all changes in use are that percentage table. Where you've got a less than 100% change in use for this, remember you sometimes need to charge output at 100 and claim the remainder of the input. And that's what causes shit in an exam. So just as a basic summary at this point in time, partial change, when it happens, we do nothing. We wait for year end. We use the market value at year end, lower of cost or market value, times by percentage change in use, only if it's 10% or more. So if it's 10%, you still have a partial change. Okay? Times 15 over 115. Guys, comfortable? If you have a total change in use, it's immediate. If it's an input, it's lower of cost or market value. If it's an output, it's on market value. If it's 0 to 50, normal. If it's 50 to 0, you need to charge output on 100% and claim the input VAT that you didn't claim back. So it's slightly different. And if you can take that out of here for now, that would be fantastic. Are you guys comfortable with this? Does that make sense? Okay. Guys, I saw an exam question, so I'm just going to finish with this. Okay. So what they did was they basically said, listen, you've got everything is residential rentals, and you decided to convert these specific flats into commercial rental flats. Okay, and they treated it as a total change in use. Can anybody tell me why? So you look at that flat, has that flat been 100% change? Yes, so it's not a partial change, it becomes a total change. Is that all right? Because each individual asset, you've gone from VAT to, sorry, from exempt to VAT. So please don't look at something and say it's a percentage. If they're asking you to look at individual assets, treat it as an individual asset. But I'm going to do that in some type questions with you as well. Okay. You guys comfortable with this? Does this make sense to you? Okay. You don't need to get this right now. I'm just doing an intro. You're welcome. Just look through the notes. This is the hardest part of CTA VAT. This and going concern, which I'm about to do with you now. But do you understand the logic behind it? Most people, sorry, have I got someone that's a repeat? Just let me get a repeat. Who hasn't gone to lectures before? That did this last year by themselves. Did you know any of this last year? No. They ask it, you die. It's just pure and simple. Do you understand logically why partial is at the end of the year, why total is immediate? To screw the taxpayer principle on outputs and inputs and all of that. If you can do that, then it's pretty much okay. Because normally this gets asked, and I've marked these questions before. I remember there was a situation about 6 years ago in a year-end exam. They gave total change in use in the last question. It was probably the most pleasurable thing I've ever had to mark in my life because no one wrote anything. It's the best thing. You get paid for something that no one writes anything for. Okay. Okay, let's carry on. Yep. Yep. Shoot. Is a total change because it's non-VAT to VAT. And 50 to 0 is total change because I was VAT, but now there's no VAT on it. So every time there's a 0%, it's a total change. Every time there's no 0%, it's a partial change. Okay. Guys, sale of a going concern. Okay. So I'm just going to explain this to you nice and simply. You have a choice as to how much detail you want to do on sale of going concern. Is it going to get asked? Probably. Okay. Is it probably the most popular question in a board exam for VAT? Yes. Okay. But they don't normally go too overboard with it. And let me just explain how this works. So if you can understand SARS's logic, you will never have a problem with this. So let's do T accounts. Okay. And I'm going to do SARS's T accounts. Is that all right? So let's imagine a good gets sold for 115 and we zero rate it. Everybody comfortable? Now, why would you want to zero rate a transaction? So I was consulting on a transaction to 350 million rand. You'd rather have the 50 million rands worth of VAT in your bank account rather than paying it across to SARS and waiting for 5 months for them to finish off with their VAT audit before they give you a refund. So why do we do going concern, zero rating? Because the money is better in our bank account than in SARS's bank account. Do you understand why we want to zero rate? Okay, so let's imagine it's 115 million rand. The guy sells it, and he pays how much across to SARS? 15. And the buyer that buys it from SARS, what happens? Claims inputs, and what is the net figure for SARS? 0. So do you understand why SARS is happy to zero rate? Are you guys comfortable with that? Because normally what happens, they end up in a net zero position. Happy. Now here's the problem. Let's actually change the example around. The guy sells it, and what is output VAT always in terms of SARS, as long as it's not a fringe benefit or an insurance payment? What is it? It's always at 100%. Does everybody understand that? So how much is SARS going to collect? 15. And let's imagine he sells it to a partial vendor. And that partial vendor can only claim 40% of the VAT. So what is going to happen with the partial vendor? He's only going to make a 6 Rand VAT input claim. Does that make sense? So what is SARS's net cash flow? 9 million SARS is collected. Happy. So let's just have a look from the seller's perspective. What has the seller got? Sold it for 115, paid 15 Rand VAT across. What is the net position of the seller? 100. Happy. From the buyer's perspective, he's going to pay 115. He's going to claim 6 Rand input. And what is the net cost going to be? 109. Are you guys comfortable? So guys, if we zero rate the transaction, what is the buyer sitting at? 100. And what is the seller sitting at is 100. And how much is the buyer sitting at if it is zero rated? 100 as well. So tell me, who should pay the 9 Rand to SARS? The buyer. So guys, here's the thing. Going concern, the whole principle of it is that even though you are buying something, you are paying output VAT to SARS. Let me say that again. Even though you are buying something, you are paying output VAT to SARS. And why? Because it's the only thing that's fair. Because if the transaction was not zero rated, SARS would collect 15 from the buyer, pay you 6 back, and SARS would have 9 million Rand in the bank account. The moment you zero rate something, what happens? The buyer is sitting at 100 still. So the buyer doesn't need to do anything. Not the buyer, the seller, sorry. The buyer, what does he need to do? Who's got a benefit of 9? The buyer. Therefore, what does the buyer have to do? Output VAT, even though he's buying something. So remember, it's a very difficult concept to say, I'm buying something and I need to account for output VAT on the thing that I'm buying. But do you understand why there's output VAT? Because if you want a zero rate, and here's how the basic rule works, guys. The basic rule says, if you zero rate and you're both 100% vendors, no problem. But if the buyer is less than 100% VAT vendor, what is the buyer required to do? Account for output VAT on the exempt portion. Does that make sense? So guys, in this question, it's 40% VAT. So what does he need to do? He's going to say it's 100 times 15% times by 60% exempt. I need to give the exempt portion back to SARS. Because when I did my VAT input claim, I could only claim 40. I lost 60. So whatever I've lost, I need to give back to SARS. And that's how going concern works. Are you guys comfortable with that? And that's a Section 18A adjustment. Okay, not for donations tax. But do you understand the concept here? So, and there is a little bit in your books as well. So I'll get you to tag some stuff. So here, guys. Sorry, so have a look here. It says A Limited, this illustration here, there. It says A Limited sells a business to B Limited for 1 million ex VAT. The sale is zero rated. What are the VAT implications if both companies use the assets 100% for taxable supplies? So zero charge by the buyer, zero claim by the seller, everything's hunky-dory because that's what would happen. And then it says part B, the seller uses the business 80% for VATable purposes and the buyer will use the business 100% for taxable supplies. The seller bought the business 3 years ago for 342. Now, here's the thing, guys. It's a really, really strange thing that's going to happen here. So, zero VAT charged by the seller, zero VAT will be claimed by the buyer. Are you guys comfortable with that? But, guys, what can the seller do now? They've charged VAT on 100% of the selling price, correct? Even though it's at 0%. So what is he allowed to do? Whatever he didn't claim for VAT originally, what is he allowed to do now? He can claim it. Because what did we say when you dispose of assets that you didn't claim all of the VAT on? You get to claim. And I'm going to do a tutorial with you on this. And this is the most common exam question, by the way, this example. Yeah. Because he only claimed 70% originally. Oh, did it say 80? Sorry. I apologize. Sorry. It should be 20 and 20. Sorry. Sorry. My mistake. I really apologize. Yep. So in the homework, I'm going to give you a question called Flex. It's got this. You actually charge output at 0, and then you claim input on whatever you didn't claim before. You just tell them this is the section, and I zero rated. Here's an agreement, and I didn't claim all my VAT, and I'd like to claim my VAT adjustment. Is that all right? Okay. Next one. That's a very detailed one. Okay. Now, guys, inside the set of notes, I've got a lot of examples after this with if you use this product less than 50% for VAT, and there's special rules for that. I've never, ever seen UNISA ask it in an exam. So I've put it in there just in case, and I put it in there for board as well. But I've hardly ever seen it in board either. It's there. I'm covering my arse so that you've got everything in the syllabus. But you need to know how to do a normal transaction. So the normal transaction in an exam, guys, will be something along the lines of, they'll say 80% VAT vendor sells to 70% VAT vendor. Okay. Original cost was 3 million. Selling price is 6 million. So if you're going to do it from the seller's perspective, what you need to know at this point in time is output 0% times by 6 million times by 15 over 115. There's no VAT. Are you guys comfortable with that? Well, technically 60%. Input, what do you get to claim? 3 million times by 30% because you, oh, sorry, 20, sorry. Times by 15 over 115. Are you guys comfortable with that? Buyer. Input, 0. And you must say that there's an input claim of 0. And how much is the output claim? 30% times 6 million times. Sorry, it's 15%, sorry. Sorry, it's 0 rated the sale. So, oh no, this one's times 15 over 115. I'm right, sorry. But this one is at 15% because what is the sale being valued at? X VAT. So you've got to do it times 15%. Are you guys comfortable with that? If you can understand that, then you should be fine for an exam. Is that all right? But don't worry, I'm going to do lots and lots of stuff on this later. Yeah. Yeah, that's why input is 0. So you need to say, if this was a theory question, it's normally a theory question in an exam. And what they normally do is they say, discuss it from the point of view of the buyer and from the point of view of the seller. From the seller's perspective, you're going to sit there and say, listen, it's not an insurance claim, it's not a fringe benefit. Therefore, I'm obliged to charge VAT at 100% of the selling price. However, because I've 0 rated it, VAT is levied at a rate of 0%. Therefore, output VAT is equal to 0. Okay. When I bought it, I could only claim 80% of the input VAT. So on sale, I'm now allowed to claim the remaining 20% on the lower of cost or market value. So that would be 15 over 115 times by lower of cost or market value, 3 million, times by the amount that I didn't get to claim, 20%. And that would be from the seller's perspective. And the buyer's perspective, we're going to say this has been zero rated. Input VAT claimable is zero because it's been zero rated. However, because of section 18A, what am I required to do? I'm required to do a section 18A adjustment, which is equal to market value times by the amount of the exempt percentage times by 15%, because it's the amount X VAT that it's been shown, because this is a zero rated sale. And that would be about an 8 or 9 mark discussion question in an exam. Is that all right? Then guys, when it's less than 50%, they've got special rules. Look, I was top student at this, and they had those rules then, and I just basically said, I did a bit of a read-through so that I could just handle it, just in case the shit hit the fan. But normally, if I was an average student, I would not even bother. Because seriously, it is very, very difficult. Just set of rules. So it's up to you. Depends on who you are. But to me, there's certain things that you don't do, and rather get this right, because this is what comes up in an exam, not the really, really complicated rules. Are you guys comfortable with that? Cool. Yeah. That's it. That's it. So only time you don't use 100% to output VAT is insurance claims and fringe benefits. Everything else is 100%. Okay. So that's there. I'll show you how to use your cycle legislation handbooks. What's it? Okay. Just go past leasehold property. 6, cessation of business. If I was a level 1 student, they love asking us in level 1. They do ask it in level 2 as well. Okay, but like this is like a stock standard. There's lots of stuff. I can remember lots of times that they've asked this for level 1. Guys, I think this was in the level 2 exam though at the end of last year. So let me just basically go through. Cessation of business is here because all of the stuff I've just taught you is going to need to be done. Is that okay? So let me just explain what happens. What happens if you stop your business? SARS says you deem to sell all the assets on the day that you sell your business. So this is a deemed section. So just like a fringe benefit is deemed VAT, and in insurance claim, there's no actual supply, it becomes deemed. This is a deemed section as well. So on the day I stop trading, I'm deemed to sell all of my assets. Is that all right? So essentially what's going to happen here, guys, is you're going to be deemed to sell all your assets, and you're going to need to account for VAT and whatever's sitting inside your balance sheet at that point in time, if that makes sense. Now, the value of supply here, guys, it says lower of cost or open market value. So for cessation of business, it's on lower of cost or open market value. Okay, now I just need to explain something to you. If you're on a payments basis and you've got creditors, have you ever accounted for the VAT? No. Therefore, I might need to account for it. If I'm on an invoice basis, I've already accounted for the VAT, so I don't need to make an adjustment. But I just want you to be careful with these, because you need to see whether you're on a payments basis or a invoice basis, because you need to work out whether you've claimed it or whether you haven't claimed it yet. Does that make sense? So essentially, let me just go through to an example and you'll be able to see how this works. So it says A Limited, registered as a vendor and bought goods and fixed assets and claimed input VAT and such purposes. Purchases. The company ceases to be a vendor and deregisters for VAT. At the date of registration, the company had stock with a cost excluding VAT of 20 and an open market value of 25 including VAT. The company also had a delivery vehicle with a cost of 20 and an open market value of 15. So guys, the moment you stop trading, what do you do with the stock? You deem to sell it for the lower of cost or open market value. And guys, whenever you're doing this, because you're timesing by 15 over 114, it's always the amount including VAT. Is that all right? So a cost of 20x VAT is a cost of 23 including that. Happy? So which one's low? The 23. So your claim, 23 times 15 over 115. The delivery vehicle is 20 and 15. Which one's lower? 15, so you deem to sell it for 15,000 times 15 over 115. You guys comfortable with that? Okay. Here are a couple of things that just cause stress in your life. So if you can do this example, you should be fine on anything for a number crunch on cessation of business. It says, A Limited ceased business and had the following assets: trading stock with a cost of 115 and an open market value of 171. So what are we going to do? We deem to sell the trading stock for what? 115. A motor car at the cost of 230 and an open market value of 130. You don't change rules, guys. If I couldn't claim input VAT, I don't need to charge output. Are you guys comfortable? Do you understand why this is asked as a question? Because you deem to sell, but you still got the normal rules that apply. Next one, trade debtors owing of 400,000. 57 was considered to be a bad debt that has not yet been written off. Now, guys, A Limited has got to be on an invoice basis. So have you already put the debtors into your VAT? So what are you allowed to do? You can claim the bad debt because we've put it into. If they said that this was an individual registered on a payments basis, you couldn't claim for the bad debt. Huh? Next one. It says creditor outstanding for 5 days of 11,500. What are you going to do? So they say you've stopped the business. You have not paid for the creditor. Because you have not paid for the creditor, we are going to give the VAT back. Are you guys comfortable with that? So any creditor that you have not paid for, you need to give the VAT back to SARS when you stop the business. Next, it says creditor outstanding for 370 days of 23. No deemed output had been made for the debt outstanding for 12 months. So guys, we haven't done the 12-month adjustment yet. So remember that 12-month adjustment. Goods not paid for within 12 months. So what do we need to do? We need to give the VAT back because we haven't paid for it. Are you guys comfortable? And then the next one says credits outstanding for 390 days of 34.2. A deemed output VAT was raised in the previous VAT return. I've already adjusted for the VAT, therefore I don't need to do it again. So with creditors, really watch out. So cessation of business, guys. If you haven't gone 12 months yet, you're supposed to give the VAT back. I haven't paid for it, I need to give the VAT back. If I've already made that 12-month adjustment, I've already given it back, so I don't need to give it back again. Next one. It says bought an asset for 575, only claimed 40% of the VAT as an asset and used 40% for taxable supplies. Open market value of 784 at the date of ceasing the business. So guys, you've got to do the output VAT on 100% and then claim the input VAT on, what did we claim? 40. So you get to claim the input VAT on the 60 that you haven't claimed yet. And then it says bought an asset for 575, only claimed 40% of the VAT. On acquisition, is the asset used 40% for taxable supplies. Open market value of 230 on the date of ceasing a business. So again, guys, you've got to do output VAT on everything and input VAT on the lower of cost or market value. Guys, comfortable? If I said this was a card that was used for the managing director and it was there, you just times by 40%. Guys, comfortable with this? Sorry?
After you seize the business, wouldn't you still pay the creditors?
Yeah, you still need to pay them. SARS just says that if you haven't paid them when you stop VAT trading, I want the money back. So before you stop trading, just make sure you pay your creditors first. Otherwise, you're going to have to give the VAT back. Does that make sense? Okay. Yep. Financial immigration. Okay, so when we do test 2, what's going to happen is that you deem to immigrate, and there's certain rules on deeming to immigrate. Okay, so can I just go through certain things with you? So one of the most common exam questions is where they ask you to do income tax and VAT at the same time. Okay, and the income tax and the VAT are not always the same. So for capital gains tax, if you immigrate, you deem to sell all of your assets at market value on the date that you immigrate. So you could have something similar happening with that. But you understand that you're moving from a VAT regime to a non-VAT regime. So you could actually have a total change in use for it. So like if you ever see a donation in an exam, I know that people see donations and they want to calculate the donations tax. Do you understand that that's actually a change in use as well? Think about it. So someone from child welfare comes around, they've got a sob story, you manufacture tables, so what do? Yeah, I have some tables. Where, what have you actually done? It was 100% VATable, the tables, because you're going to sell them. Now that you've donated them, what is it? 0% VAT, so what do you need to do? Total change in use. And because it's an output, it's a supply on greater of open market value and or selling price, and you'll do the adjustment. Does everybody understand? The tax might be something different because if you donate to a registered PPO, you're only going to do the donation at cost, funnily enough. But I haven't taught you that. That we're going to do in test 2. Okay, so you'll see the income tax is at cost, but the VAT is at market value, and you're going to need to be able to deal with all of those things. But immigration is dealt with in test 2, so I will show you what happens. And I will cover what happens when companies immigrate as well as what happens when individuals immigrate. Okay, so that's there. Guys comfortable with this? So just as a general, do you guys understand? Okay. So I apologize just with the pace. As I said last week, my lectures are not there because I've taken them off now. I took them off now because it's not my stuff. I'm going to just re-record them tomorrow or on Thursday or Friday at the latest. Let's see how I can do. But there'll be parts of it coming up as we go. If you want to go back to refer to stuff, will you have a look at this? Guys, there's some homework that's going to be put onto it. So you'll see for Mac, I've actually got 2 examples that I've put onto the pacer, which I want you to do for homework for Thursday. So you'll see, and I've got, if you want to look at the videos, I've got a full discussion video on how to do the whole question. I'm not going to do it in full detail on Thursday. I'm going to go through pertinent points with you just to make sure that you understand it. But I have put 2 questions on. Please, can you have a look? I'm putting up a question for tax called Flex. Okay, it's an old exam question. It's the most common question that gets asked in exams for going concern. So I'm putting up a whole lot of individual questions just for next week. Next week when we start, I'm going to go through all of those questions in class. I would like you to have had a look at them. Is that all right? But I will work through them in class from start to finish, all of the examples that I'm putting up for that at the moment. So technically speaking, I've done all of the important stuff for that with you. Okay? What I'm going to do next week is I'm going to do all the level 1s with you, but literally 10 minutes. Betting transactions, you do this. Okay? Door-to-door sales, you do this. Lay-by sales, you do this. Okay? And I'll give you all of that stuff. And then I'm going to spend most of next week is going to be a full tutorial session going through donations tax and going through VAT with you in class. Is that all right? Please bring your assignments with. I will work through lots of stuff from your assignments. I prefer to do a lot of questions from your assignments. Is that all right? And I'll work through the stuff.